All right, let's talk about gold. For the last few years, it has been on an absolute tear, and it seems to be breaking all the old rules of finance. So we're going to dig in and figure out what on earth is going on. Let's get right into it. So picture this. It is the 21st of October, 2025. Gold has been on this incredible historic run, up. And then, bam, the market gets hit with a flash crash. The price just falls off a cliff, dropping 6.5% in a single day. We're talking the biggest one. Day drop in more than a decade. It was a really violent punctuation mark at the end of a very, very strange period for the gold market. But here is the thing. If you only focus on that crash, you are missing the real story. The true mystery is why gold finally fell. It is why it got so high in the first place, completely defying financial gravity along the way. It really makes you wonder, right? What powerful new forces are out there literally rewriting the rulebook for this ancient asset? And that leads us straight into the first part of our investigation, trying to unravel gold's great mystery. Okay, so here is where things get really weird. A fundamental law of economics is basically being broken right before our eyes. For decades, the rule was simple. When interest rates go up, the price of gold goes down. It makes sense, right? Gold doesn't pay you any interest, so when you can get a good return on a safe government bond, there is a higher opportunity cost to holding gold. But since 2022, that rule has been shattered. The Fed went on one of the most aggressive rate hiking cycles in history, and gold didn't just hang in there. It returned a positive 13% in 2023. This right here is the core of the mystery. So to solve this puzzle, we really need to understand what we're dealing with. Let's break down what I like to call the three distinct faces of gold. Gold's real power comes from this unique trinity of value. First, it is a commodity. You know, it is used in physical things, from the jewelry we wear to the high-tech electronics in our pockets. Second, it is a currency. The gold standard might be long gone, but believe me, it is still the ultimate form of money, a core reserve for central banks all over the world. And third, it is a financial asset, something that is bought and sold on markets every single day, just like a stock or a bond. Now, for an investor like you, this trinity creates three really important jobs in a portfolio. It acts as a safe haven when geopolitical storms are brewing. It is a long-term shield against inflation, slowly eating away at the value of your cash. And maybe most importantly, because it often zigs when stocks zag, it is the ultimate portfolio diversifier. All right, now that we've got the basics down, let's get to the heart of it. Part 3, the new price drivers. What has really been pushing gold to these new heights? Well, it turns out there are two new sheriffs in town. Two huge structural forces have become so dominant that they've essentially built a new, higher floor under the price of gold. And they're strong enough to overpower those old-school rules about interest rates. And here it is. This chart is the aha moment, the smoking gun. In 2022 and 2023, the world's central banks went on an absolutely historic buying spree. They bought over 1,000 tons of gold each year. Now, to put that in perspective, that is more than double the average of the entire previous decade. And this isn't just random speculation. No way. It is a massive strategic shift, a de-dollarization trend. Countries are actively trying to diversify away from the US dollar to protect themselves from things like geopolitical sanctions. The second major driver is that constant, low-level hum of uncertainty in the world. From trade wars to actual wars, the world just feels riskier than it used to. And this has created what is called a permanent risk premium that is now baked into the price of gold. Investors are just willing to pay a little bit more for an asset that sits completely outside of any single country's political or banking system. Okay, so we have these powerful new forces at play. But does gold's recent behavior actually fit with its history? It is time to check the report card in Section 4. First off, a quick reality check. If you look back over the last century or so, gold has returned about 5% a year. Now, that is not bad, but let S be clear. It is not a growth engine. It is not going to give you those explosive returns like the stock market can, which has done closer to 10%. So you have to remember, explosive growth is not its primary job, but, and this is a huge but, this is where gold really earns its place in a just look at what happens during the stock market. S lost decades. In the 1970s, you had crippling stagflation. Stocks basically went nowhere. Gold. It returned an incredible 35% per year. Fast forward to the 2000s. With the dot-com bust and the global financial crisis, stocks actually lost you money for the decade. And gold. It was up nearly 15% a year. It is not a growth engine, it is a lifeboat. Okay, so mystery solved. Gold's wild behavior actually starts to make a lot of sense in this new world we're in. So what should you as an investor do about it? Let S move to our final section, your investor playbook. You've basically got three main ways to get in on the action. There is physical gold, you know, bars and coins. This is really for the wealth preserver. Someone who wants to hold it in their hand and have zero risk of a bank or brokerage failing. Then you have gold ETFs, which are perfect for the modern portfolio builder. They re-cheap, you can buy and sell them in a second, and they track the price of gold. And finally, you've got gold mining stocks. Now this is for the high-risk speculator, because you are not just betting on the price of gold, you are betting on a specific company. S ability to pull it out of the ground efficiently. You know, this quote from Alan Greenspan, the former chairman of the Fed, really hits the nail on the head. He said, "In the absence of the gold standard, there is no way to protect savings from confiscation through inflation. It just gets to the core idea. In a world where currencies can be created out of thin air, gold is an anchor. So how much should you actually own? Well, most financial strategists will tell you that a smart strategic allocation is somewhere between 5 and 15% of your portfolio. Look, it is not an all-or-nothing bet. It is just a small, but potentially crucial slice of your portfolio that is playing defense. When you look at all the evidence, the big forces supporting gold, unprecedented debt, geopolitical risk, they're not going away anytime soon. So maybe the real question we should be asking is, will gold keep going up? But instead, in this crazy world, can my portfolio really afford to face the future without this kind of protection?